All right, good morning, everybody. We have my friend John Rubino with us here today, and we're going to let John introduce himself and his company.
Yeah, good morning, everyone. Thanks, Andrew, for having me. This is great. I was looking forward to it all week and hope everybody had a great holiday. Exciting to get into 2023. My name is John Rubino. I live in Northern Virginia, right outside of Washington, D.C., originally from New York. And I've been, my first career was in the Navy. I was a Navy pilot for 20 years, from 1997 to 2017. And I retired in 2017 after 20 years. Live here with my wife, Stacy, and my four kids. And I've got a passion for real estate. I had a passion for real estate back in 2004, 2005, when I was about halfway through my career in the Navy. I was an active investor with new construction properties, some fix and flips, and really got into it through some friends of mine in the military, who I still keep in touch with and work with. And it's been a passion since then. Just the excitement of locating the opportunity, working with great people, and building amazing relationships, and just really putting everything together to make it an exciting opportunity to not only enjoy but to also do and enjoy for a living. So about halfway through my career, I started to invest passively after a little bit of a stint actively, and for about a 10-year period. And I really got the opportunity to really look at the details of projects, the underwriting process, what really qualifies for a good project, different asset classes and locations, how to really look at a sponsor and understand their experience level. And so, it was kind of a free education at the same time, making money and returns on my capital invested with these groups. So, fast forward to 2011, 2012, stationed at my last duty station here in Washington, D.C. Got about 5 years left knowing I was going to retire, and had some decisions to make, go back to work for corporate America or the government, or, take the strategy I had to invest as a passive investor for the last 10 years and turn it into a business. And that's exactly what I did. So I got together with my accountant at the time, who's now my business partner, and we stood up our company, GID Investments, in 2013. And we launched, and over the last going on 10 years, Andrew, this
Wow.
April, it's amazing. We've invested on 29 projects, of which 18 have gone full cycle, and just about 34 million total investment, with on completed projects about 8 to 10 million in profit. So we've had a good experience, good track record, good proof of concept, and just like I was a passive investor, our business is really predicated on working with solid, active sponsors who we know, that we've done business with before, we have a relationship with, and we can build a nice track record and partnership with. And then the other side of the business is inviting friends and family, and now accredited investors, highly sophisticated investors that would want to come and participate on our projects through syndication. So that's kind of the two parts of the business, and having fun, growing, and doing it now full time. So yeah, that's pretty much it in a nutshell.
Yeah, I just wanted to add in. I mean, it's not that common when you're an LP looking around and you're trying to meet and network with syndicators and operators, GPs. There's not many people that have been around as long as you, John. One,
Thank you. I
there's not many
appreciate it.
people that have done the volume that you've done and have that many go full cycle. So if you're listening to this and you're an LP, not investment advice. I'm not saying investment advice, but
Yeah.
it is something to consider that, there's a lot of newer LPs running around, trying to get investors money. I've always looked at it. That's really should be friends and family. If you're a new LP, you really need to be with an experienced sponsor. Let friends and families finance the education of a newer sponsor. John's been doing this for a while. We talk offline quite a bit, John and I, and bouncing ideas and sharing information. He's just a really good guy. So, John,
Thanks, Andrew. I appreciate
we're
it.
going to step back a little bit. As I mentioned, not many sponsors actually have gone through the GFC. What did you learn from the GFC that you might think some sponsors today are missing because they didn't have that experience?
I think just, first off, having the foundation, right? Understanding the business, looking at all the components. When I was in the military, we had these project managers, program managers, right? They were the kind of person that managed everything, the financing, the strategy, the concepts, the plans, all of the things that are incorporated into a program. Well, just like a sponsor, a sponsor's got to go out and understand all aspects of the business. It's not just raising money, or it's not just buying the property, or it's not just managing it. It's the day-to-day stuff. It's the ability to have everything in place, having the right parts, understanding the needs based on when they're getting into a project, whether they're buying it as raw land or if they're buying it post entitlement ready for construction, knowing the county parameters and laws to walk through that. There's a lot of things there that folks I think just hear that this is an exciting opportunity and you can make a lot of money, but there's always a lot of work behind it. So you got to really understand what you're getting into to build a good foundation. I do like your point about when you're starting out to really talk to friends and family, talk to people you know. You got to have a good team. You don't get anywhere in life without a good team. And those are the right people around you that can leverage their skill set and add value to you, your business, what you're trying to do. So before you jump in, yes, plan, sit down, put together what you need. Maybe even look at being an apprentice with a developer in your area that's doing projects where you can kind of jump on and say, hey, I'm starting out. I'd love to learn. I mean, I haven't met anyone in this business, for the most part, that I haven't seen that's wanting to give back, that's wanting to help folks to kind of learn from their mistakes and pass those on so that folks know what to expect. So yeah, I think that's the first thing, build that foundation. The second is understand the environment, understand where we're at. 2 years ago we had COVID, the impacts of COVID 2.5 years ago. We're still feeling that, and we're in the potential of entering into another cycle where we could see a recession this year. So you got to understand, okay, I got my foundation, but where are we at right now based on the big picture? And then the last thing I'd say is, what markets are you in? And how do you not take advantage, but again, leverage those markets that you're going to be successful in. And if you're out of state and you want to be in a state that's doing better, or you see potential growth, then how do you put a team together to capture success in investing in those markets? Which we've got partners now that are in Baltimore, but they've got teams set up in Charleston, South Carolina, which is a fantastic market. So we like that. They have the team in place, and they have the opportunity to work satellite from base to base, or from location to location.
You bring up an interesting dichotomy for me, which always comes up with markets. On one hand, you would say, yeah, I want to be in the growth market. I want to go where the jobs are going, where new employment's going, migration. But on the other hand, you don't necessarily always want to be chasing cyclical markets, correct?
Yeah, that's absolutely correct.
Yeah, and
Yep.
then it said, on one hand, I'd like you to be boots on the ground, but if where you live isn't a great market currently, or maybe let's just say jurisdictional laws have changed, sure, you should be looking to go to South Carolina. But like you say, you can't just go to South Carolina and just willy nilly set up shop. You're going to
Yeah,
have the boots on the ground team to really make that work. So it's a little more
absolutely.
nuanced when when somebody says, "Oh, just invest in a hot market." Like it's a little more complicated than that, right?
Yeah, but good point. And also you could also learn being a passive investor, where you come in and you invest on some opportunities that are in targeted markets that you eventually would like to be an active sponsor on, or active investor. So that's another good way to learn and to see different aspects, see what a performer looks like, how does an OM look like, all that stuff that you're going to have to eventually put together to learn that aspect, and see all the other parts that are incorporated in part of a project as well.
I mean, we're going to touch the interest rate question. Like we talked
Sure.
about offline, we won't go too deep into it because I know
Mhm.
most people are, it's kind of a double edged sword. You have to ask the question, but most people are tired of hearing about it. What is, in particular, how are you seeing the interest rate environment affecting people's ability to make future decisions? So you have, one camp is very strong thinking, okay, it's going to keep going up. Another camp thinks any moment now Powell's pivoting. And then there's people like me, they're just like, I have no clue. I'm not going to try to predict it, but it makes, prognosticating difficult when you just don't have a clue what's going to happen.
Yeah, it's a great question. I mean, for me, it's just a matter of where am I at in my portfolio of projects, and how do the interest rates impact them. So, for example, if I'm in an active deal right now that's delivering, and we're making mortgage payments interest only, let's say, and we've got floating rates, then yeah, we're being impacted by that. We're having to dig deep into interest reserves, and what we conservatively underwrote is still, having some challenges. So that's one of the challenges, is that, you got an interest reserve that's going to be depleted. More cash needs to be infused in order to make those interest only payments. And now you're potentially looking at a scenario where, okay, where do I need to get to stabilize and pay off the mortgage and then make some cash flow? So those rates make it challenging in that environment when you have an active deal on the market being leased up, because now you have to dig deeper and get your cash and have enough available to pay those mortgage payments. The other issue is that, as those interest rates go up, those cap rates go up. So now you're looking at valuation concerns. So is the valuation, is it at, the point that we underwrote it, or is it at 80% or 90%? How does that impact my returns? How does that impact cost? Inflation and interest rates have been a problem for the last, I'd say, year. And I think that, inflation, I'm reading, is coming down. I know interest rates are probably going to stabilize. There could be some bumps, but like you said, we don't have a crystal ball that knows it all. I still think there'll still be some bump ups. And so from the active side, now going into the underwriting on new deal side, I call it the triple headed dragon. I mean, so you're getting less money, right, from the bank. So you're getting less leverage debt. In the past, when things were good, 75% loan costs, 3.5% interest rate. Now it's 50 to 55%, 6, 7, 8% interest rate. So less money, more expensive money. So where do you got to go to get the rest of that money? Equity, right? So that's the triple headed dragon. Paying more for debt, you're getting less debt, and now you got to go out and get more expensive equity, which is really changing the scope and the parameters of underwriting now. So you have to really bake that in and see how that impacts your numbers. And you and I spoke a little offline. We were spoiled the last couple of years where, a 5-year project, and you're making, X amount on your returns, and then when we appreciate this and that, well, people were selling 12, 24 months into the deal, and they were making exceedingly high returns. Well, now it's like you said, and we were talking about, now it's going to be a little more like, okay, we got to pro forma it out the cash flow, make sure we're getting cash flow, and then staying in that deal potentially for the full term before we come out and make that potential appreciation returns. So yeah, there's a lot there.
Yeah, that's just great. Yeah, that's like a masterclass, John, in a nutshell of the challenges the GP and the LP is facing. I often look at it from the LP perspective. That's the bulk of my history and my my time, and we have to just be so much more fussy now about the purchase price, because the returns, as you say, are just dragged down. Lower LTVs or LTCs, higher reserves. And one of the things I'm concerned with is, when I ask somebody, how did you come up with the terminal cap rate, the exit cap rate, the cap rate we're going to sell ideally in 3 to 5 years at? A lot of guys have said, well, traditionally it's always been 10 basis points a year. And I'm like, well, the conditions of the world that traditionally it was set in are not the conditions of today. So I'm
Mm-hmm.
not a big fan of well, it's always been 10 basis points a year. I don't know how to come up with an exit cap rate when the Federal Reserve can raise interest rates, 100 basis points, 50 basis points, 75 basis points, you know, in chunks of, every so many months. How do you do an exit? How do you do a terminal cap rate?
Yeah, it's a great point. And of course, as LPs, we want to underwrite to being conservative, right? So, one of the things I do is, if a GP brings me a deal and they're, let's say, underwriting to a 4.5 or a 5 cap, we'll say, okay, based on your cap rate, this is what we see the returns being. And so if we're going to believe in your model, A, we want to make sure we back it up, and B, we want to make sure that we're protected to see our returns prior to, and then obviously we share in the rest, right? So let's put our money where our mouth is. If you're going to stand at a 4.5 to 5 cap, then how are you going to incentivize me to come into that deal when my biggest concern is protection of my money and return on my investment? right? So that's where we put in parameters. We put in waterfalls that really kind of are a little more heavier on the front end for our benefit. And then, yeah, once we hit those, they have every right to get their catch up. They got every right to make their promote, and then we get to share the rest. So
Oh, okay.
there's ways to mitigate it, but yeah, you're right. I mean, you just got to be smart about it. You have to look at it conservatively, and yeah, I mean, interest rates and cap rates are kind of they run synonymously. So if those interest rates are going up, and we were underwriting 4.25, 4.5, now it's going to be 4.5, 5. So what does that do to your valuation? And you hit a really good point. Acquisition is always big, especially now, because I think the one thing that a lot of sponsors have on their side, the smart ones, is that the delta on the valuation from acquisition through to potential sale is got a nice big chunk of meat on that bone, so that if you do have to shave off a few shades of that meat, you still have got a nice valuation that obviously paying the bank back, and the return should still hopefully keep you in that let's say hitting a double to a home run on your returns.
Yeah, that's great, John. One of the things as an LP, is you guys do it on your own, being more sophisticated and you're kind of at that sponsor level. So, I really like to see sensitivity analysis. I don't really
Mm,
want to be calculating it. I'm just the LP. I shouldn't have to be doing work. The whole point of
yeah.
being passive, right? I know you're
Yeah.
looking at sensitivity analysis. What is your thought on my opinion that I wish more of the GPs when they were doing a pitch deck or pitching to investors would show a sensitivity analysis, usually to two things. One, rent growth, so it's just easier for the investor to understand, and then the cap rate. To say, if everything goes just to pro forma, just like we planned, this is what your IRR will look like at a five cap. This is what it'll look at at a 5.5. This is what it looks like at six. We don't have to go into like every 5 basis points kind of thing. But what do you
Yeah.
think about somebody that my opinion that more GPs really should be on in writing showing them the range of possibilities, not just this is the pro forma, because we don't know it. I mean, the world could get better, the world could get worse. We should show people upside, downside, and the spectrum of sensitivity.
Yeah. I mean, given the risk that we take on as LPs, given where we sit on the capital stack, and the fact that, we're really pretty much at the bottom of the barrel, smallest piece, but making the biggest returns. And for that risk, we're giving up a lot of collateral. We're giving up a lot of those higher positions so that we get those bigger returns. And that makes sense. But my biggest thing is always going to be, hey, how are you protecting my money? And I think that's exactly what you're alluding to, is that you're protecting my money by building in sensitivity and break evens that still show that in historics, where this market we're in is at its low, was at its lowest, or in the slim years, or the years that were the most difficult, we're still going to break even, or we're going to still make a 5% return, right? So that you're absolutely right. I think I've seen a lot of fantastic sponsors do that, where they have a chart and they show, hey, my base case is 4.5 cap, but here's what it looks like if we sell it at a 5 cap, or a 5.5, or a 6, or hey, here's what if we sell it at a 4.25 or a 4. So yeah, I like that base case, uh, you know, worser case, better case, and also, if you build it into your distribution waterfalls, is that, hey, if we do better than projected, we should share in that, right?
Oh yeah, definitely.
And then, yeah, there should always be, even if it's like 80-20 split pro rata in favor of the sponsor when he hits their profs, return of capital, and their hurdles, but there should still be an out, let's say 80-20, or 85-15, that takes you all the way out if there is upside. So I think that's important. But yes, I agree. I mean, not only do I want to see my sponsor do that, but then my team will do our own break even and sensitivity, and make sure that A, the sponsor's work is accurate, and B, that what we see makes sense, and that we're comfortable. And again, going back to my earlier point, if we see on our sensitivity models, $1.90 per square foot's a little bit aggressive. Let's
Okay.
let's build in a 180 and see how we do, and then go back to the sponsor and say, hey, we're building a 180. We'll go with your 190, but this is what we want on our incentivized waterfall.
Oh, okay. Um, while we're on that subject of sensitivity analysis, the third one that it's not a deal killer for me, the one I like to see would be economic vacancy. We're
Hmm.
assuming, a pro forma is, 80%, 90% occupied. What are the levels where we start running into cash flow problems? What is economic break even vacancy? That's the
Hmm.
third one I like. When you're
Yeah.
looking at as an investor and you're trying to align, the sponsor's interests with the investors, one of the things I think investors are having a harder time too with is not just the returns, but also the expenses. Because if you notice, and it's hard because every deal is different. There's different types of lengths, and there's different asset classes. Understanding what is the market going rate for asset management fees, for an acquisition fee. When is a disposition fee appropriate? When is it not? It all depends on the length of the hold
Yeah.
and the type of the asset. But what are the kind of expense ratios that you would look at and just be like, no, I'm out. What an investor looks at, if they say a 3% acquisition fee, for instance, for a standard deal, it might apply to some weird deal, but for like a standard, I'm going to buy an apartment, fix it up, and sell it in 5 years. What are the things that an LP should just be going, shaking their head, saying, no, 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 I'm going to look at another sponsor?
Well, two things, quantity or quality. I mean, I don't want to see a lot of fees. If there's 6 or 5 fees, I'm like, well, wait a minute, hold on. I mean, what is this one? If I start pulling the thread and seeing this person making 5 or 6 types of fees on a deal, that's a little bit weird. So I'll have them walk me through that. The second is, yeah, you're right. What's that sweet spot? And usually it's around 2 to 3%. It's what I'm comfortable with. And again, it's performance based. It's incentivized based on that performance. So if someone's getting paid a fee at closing, walk me through why you're getting paid that fee. If it's because you're doing all the legal work and you're doing all the preparation stuff and getting everything lined up to close and get the acquisition, okay, that makes sense. But if you're just getting paid a fee for just getting the money and closing the deal as a sponsor, that's not too exciting. So if you make a development fee, when do you get that development fee? How is it paid out? Is it paid out on draws, or are you getting it paid in lump sum? What percentage of the project has to be completed in order for you to get that? So those are the types of questions you want to be asking a sponsor to make sure that they can kind of, transparently share that with you and you have a good understanding of it, so that again, everything is based off incentive. You do your job, you get to a point where you need to get, great. You get paid your fee, and that's fair and that makes sense. Yeah, I think as well as to promote, how does your promote work? How do you get paid? When is that paid? Am I getting my return of capital with my preferred return, and then you're getting your catch up, or how does that work? And if a deal ends up going, let's say, a little longer than planned, are you willing to give up a little more of that promote as far as the payout to give it to us before you make that percentage, since we've gone a little late, or there were some challenges? These are all the questions you should be able to ask during that. We've had a deal that we were supposed to be done in like 36 to 40 months, and it went an additional 18 months because of
Oh, wow.
COVID. So what we ended up doing on our waterfall, which was, hey, we have a very healthy waterfall because we do development and construction. So there's a lot of risk. So we pay out a 12% pref, and then we give back our investors their money. We get our catch up. And then we typically do around a 60 or 40 split in the favor of the investor to get them around an 18% hurdle, let's say. So those are good returns, there's a solid. But when you have a deal that's gone longer and, that meat's getting shaved off a bit, one of the things we said was, you know what, we're going to pay them their pref, we're going to pay them their return of capital, and then we're going to give them their portion of the profit split before we take our promote. So that went above and beyond what we were required to do. And you have to do those things, Andrew. As in tough times, you've got to realize that your investors, for us, is really the group that you have to make sure is understanding and satisfied. Otherwise, you're not going to have them come back and do any more deals. So the better care you take care of your investors from us, and the better care our sponsors take care of us, the more likely we're going to be able to enjoy the good times as well as the bad times if there's challenges.
Where, the people have different opinions on this subject. Where do you fall on how much skin in the game a sponsor GP has in terms of cash, their own real money? One of the
Yep.
catches being, someone will say, well, I've invested X amount of money in the deal, and then you do the backward math and like that's kind of just the acquisition fee. You don't really have skin in the game financially. Now everyone has skin in the game. You have your reputation, your sweat equity. I get it, but people like me really like to see a deal where the sponsor believes in the deal so much that they have money in it. But the catch is if a sponsor is in a lot of deals, which is a good thing because they have the flow, they they can only have so much cash, right? So they can't be putting in huge amounts of money in a specific deal because they're running 3 5 deals a year. Where do you fall on that spectrum of how to view skin in the game?
Yeah, so my need for them is to have around 10% of what
Hmm.
I'm bringing into the deal in the equity side. What I would like is I would like them to have 10% of the total amount of money in a deal. But if they're bringing in 10% of either what I'm bringing in or 10% of the overall equity slice, then and that's what I meant, not the entire deal, obviously, but 10% of that total equity piece, if it's general or whatever it is, I'd like to see 10% come in because that gives us the comfort knowing that they've got a chunk of that skin in the game to participate. And you're right, if they say, well, I'm going to bring 10% in, but it's not till 8 months or 10 months into the deal when I get my development fee. Yeah, I'm not a big fan of that. But if they say, hey, when we close and we got the property in our control, we get that check out, that 10% is going right into the deal. That's fine. But yes, you need to have that hard capital in the project. About 10% is what I usually want to see.
Oh, okay. Any other tips for LPs? We covered a lot of the bread and butter basics of
Yeah.
it, but is there any market unusual market trends, geographic markets, or new business trends that excite you for LPs to take a look at?
Yeah. I mean, for us, like I said, asset class really isn't as important as location and the experience of the sponsor in the asset class to bring to us. So, I mean, obviously, that's the most important that we can hit our numbers, that we like the location, the experience. If a student housing sponsor brings me a senior living deal, I'm kind of scratching my head and saying, why are you doing that? Or if there's a new GP, if there's a GP that's got great experience in Charleston, South Carolina, but now they're getting into Charlotte, North Carolina, and it's their first deal. Okay, well, walk me through your familiarization. What is the difference in the process to approve plans and permitting, and have you built that in? And a lot of these guys have larger deals. I mean, we're doing deals anywhere from 50 to $200 million cap, total cap. So it's like, all right, they bring in a joint venture partner, and that joint venture partner is located in that
Oh,
area. That gives me a little more comfort as well. So that's also a plus. Um, the big thing I'm always thinking about too as an LP is making sure that what the sponsor communicates to me is also in their legal documents. So, you could tell me everything till the grass is green, but if the grass is yellow in your operating agreement, I'm going to look like a fool, right? So you got to make sure you do your homework. Some folks will hire a business attorney to go through that. I know you're an attorney there, and you've
oh
got
no,
some
no, I'm
folks
not an
there.
attorney. I work for
Oh no,
attorneys.
yeah, I'm sorry. You've got people in your network, but yeah, I think that's always a plus is to bring in an attorney to look over your OAs just to make sure. The big things for us on the operating agreement, obviously, is the waterfall, how money's returned, capital calls. We do not participate in mandatory capital calls. It's just our philosophy. We don't have to. We're not required to come in. So if capital is needed, sponsor will go out and get that, or they'll offer us an opportunity, or we could see our ownership percentage dilute a bit, which is understanding, but we don't have to be mandatorily required to bring in additional capital. So that's important. But yeah, I think that's probably the next big thing is like once you finally feel, okay, everything's good, I'm ready to press the go button. Let me take a look at the operating agreement, private placement, just to make sure that all of that stuff that they communicated to me is captured. And you know this too, is save all the emails, go back, study the emails. I create a little diary on every project I do.
Yeah.
And I take all of my emails and that goes on my diary for every project. And I go back and I make sure that I read it and I highlight the parts like, hey, Jim said on this date that we're getting a 12% prof and now he's changing it to 10. Hey, Jim, what's up? Why did this change? So that's important. Keep a running log of each project, and so that way you have a good idea of how it progresses.
I really appreciate that. Thanks so
Yeah,
much. Anything else you'd
yeah,
like
my
to add
pleasure.
for anything else you'd like to add for our LPs?
Yeah, we're pretty active, so come visit us anytime. I mean, I'm on LinkedIn, you know that, Andrew. We've got our company website, jidinvestments.com, not to, to market or anything, but we've
No,
got
no,
some
no,
good
no.
information. Yeah, no, we've got some good information. I love to share stuff. So if anybody just has questions about, hey, I've got some questions about passive investing, or hey, what do you know about this market? You and I, we do real well together because we got a good friendship, and when you build those relationships and you have that trust, which is very big, trust but verify. But when you got those people in your network, you feel good about talking to them about, hey, Andrew, I've got this deal from this sponsor, and you could be like, hey, no, that sponsor, here's the problems I had. Nothing against that person, but here's what I experienced. So that's always comfortable having that team around you to feel comfortable to go out and ask questions and yeah, compare deals. It's always neat to share a deal with you or a couple of other guys we know, get their feedback, their thoughts, and same with me. I'm always happy to do that as well.
And just to clarify, you work only with accredited investors, or do you work with both types of investors?
Yeah, so it's a catch 22. You got to be careful. Obviously, anybody that's calling us that's a public investor outside of kind of, let's say, our local area, or someone we can't meet with and engage with consistently to get a better understanding of their financials. We want to only work with accredited investors because we do the predominant amount of deals we do are 506Bs. So obviously, there's got to be that existing relationship to share information. We have folks come on board and join us as an investor before we start sharing, specifics on a deal. So there's a relationship. If there's someone local to us here that I can go meet with or fly down and meet if it's nearby, get to know them, understand their scenarios, we would take in a sophisticated investor. And if we do a B, we're only allowed up to 35, and we understand that. And we go through that process. But yeah, you know, the SEC is very clear on 506C accredited, but not so much on non-accredited. So you just got to tread lightly.
Yeah, well, thank you so much. Just remember,
Yeah.
everybody, none of this was investment advice. This is all for
No.
educational purposes. Nobody. I have no business relationship with John other than we're friends. He's not sending me a. He didn't pay to be on the podcast or anything. There's no advertising fee or promotional fee. Just a great guy that
Thank
willing
you.
to share information. That was the main purpose of having John on the podcast. We're always
You as
afraid
well,
of
my
just making
friend.
sure we're in SEC compliance.
That's right.
I really
Thank you
appreciate
so
John.
much for having me. And this was fantastic. And I look forward to 2023 together with you and doing some cool stuff together.
Yes, man. All right. Thanks again, John.
Yep.